is the Fed will have to cut rates, weaken the dollar, and inflate away these debts. They don't want to do it right now, but I think over time, that's ultimately really the only solution until and unless we got a more unified government that could really take a bite out of spending. You'd probably have to take a big bite out of defense spending, and we'd probably have to raise taxes. It just doesn't seem like there's political will at this point to do either of those things. So really, the outlet is going to be the dollar. The dollar is going to devalue against hard assets, against gold, against oil, against commodities, and we're going to have a much higher rate of inflation in the future. I think that's the end game we're looking at.
To Metals and Miners, I'm its founder and its host, Gary Bohm. U.S. debt is exploding higher, and a significant amount of it is maturing over the next 3 years and needing to be rolled over at much higher interest rates, putting additional strain on the U.S. budget and deficits. At the same time, foreign central banks are now net sellers of our debt, and gold is becoming the trade settlement vehicle of choice for these central banks. While some commodities are coming under heavy pressure due to deglobalization and de-dollarization efforts. To discuss all of this and more, we're so fortunate to sit down with Craig Shapiro, a macro advisor at LaDucTrading, a cross-asset portfolio manager with 20 plus years of experience and having served at firms such as Point72 Asset Management, among others, and the owner of the firm Circle Lane Capital, an investment management firm that focuses on equity investments in the old economy and cyclical industries. Craig, thank you so much for joining us today.
Thanks, Gary. Nice to meet you.
Yeah, nice to meet you. So, Craig, how do you see the current economy and markets? Do you see it as a soft landing and new growth cycle? Do you see it as lags from the Fed tightening cycle is still to hit, and combined with higher for longer rates will lead to a sharp deflationary impulse? Do you see a stagflationary environment and no growth? What do you see?
Yeah, I'd say I see something of a stagflationary environment developing here and into the future. Basically, what we have is a government deficit in the U.S. that's really been helping facilitate better than expected growth, in the economy. And so the tightening cycle from the Fed, over the last 18 months hasn't done as much in the way of tightening and in the way of slowing down the economy because it's been offset largely by, massive deficits over the last, 3 years, and including 2023, which was a very strong year, full employment, and we had 7-8% deficits, right? So the U.S. government continues to spend, way more than it brings in, and it's really providing, extra stimulus for the economy. And so the tightening that the Fed has done just hasn't slowed down the rate of growth as much as people would have thought. And what we also have is, many borrowers, households, and corporates were able to lock in low interest rates, during COVID crisis, refinancing mortgages, refinancing, corporate borrowings in 2020 and 2021 at very low rates.
Yeah.
And so borrowers haven't been as much affected by the rise in rates yet, which is, again, has, made the Fed's tightening less impactful than I think they otherwise would have thought. So it's created this, sticky inflationary environment where, core services inflation, ex housing remains, twice, close to 4%. So 2 times what the Fed's, target for long-term inflation should be. And that's been driven largely by wage growth, which remains incredibly robust. We've also had, because of these government spending, the cost of living adjustments on Social Security have been 4 or 5%, a year. The tax bracket increases because of inflation have risen. That's made after-tax income for consumers higher than expected, which has supported consumption. So, we still have this sticky inflationary environment. But now we're finally at least starting to see, some of the signs of growth slowing, or at least we were into the third quarter of last year when rates really started to move higher. And then, upon the Yellen pivot and the Fed pivot in November, we could talk more about that. But, rates came down, bonds rallied, and financial conditions eased significantly again. So it kind of has created a little bit, another, maybe a small second wind with some of the better growth data to end the year. And so once again, we're kind of pushing out this slowdown, but it is coming. It's just not coming as rapidly as I think most people thought.
Yeah, so something of interest in there. I did see this morning, Melody Wright, a real estate consultant and expert, had shared that an increase now in home equity line of credits and refinances to pull money out of the house is being reported, to go along with some of the other consumer statistics that are out there: decrease in savings, increase in credit cards, buy now, pay later, some of the other things. And of course, just the several years of excessive higher costs. Is there a brick wall here, a cliff that the consumer is going to hit or fall over at some point?
Yeah, look, I think what we have is a fairly, we have a very bifurcated consumer economy, right? You have, upper middle class and wealthy folks who have stock portfolios and who have excess savings, who are able to earn, 5% plus yields on money market funds. And that is, very supportive of, their spending. But, you have the preponderance of the U.S. economy, and the labor force is working 1 or 2 or 3 jobs to try to keep pace. And so even though, their wages are moving higher, the sticky inflation is cutting into that discretionary, budget. So credit card debts are moving higher, and folks with credit card debts have to pay those higher interest rates. So, yeah, I think we are, getting to that point where the lower end consumer is starting to, to really feel that crimp. You're hearing some of the, big box retailers talk about that, and some of the more discretionary retailers talk about the lower end consumer coming into, some strain. So, yeah, I think we're getting there. But what we would normally get, I think, in response to that kind of slowdown would be a Fed easing cycle. Mm-hmm. And yet, I just think we still have this sticky inflation environment that makes it much more difficult for the Fed to engage in a rapid easing cycle. And even though the markets are, yearnful for one and are forcing in or are pricing in an aggressive easing cycle, beginning as early as March, it seems to me that the Fed wants to hold off and push back against that market pricing a bit, because it is fearful that we will just have a reacceleration of inflation, later on this year. And you can already see it in inflation expectations, and break-even yields have been moving higher again. Oil is starting to find a bottom. Commodities are starting to find a bottom again. So I don't really think the Fed wants to be in a position, certainly not closer to the election, where inflation is really still in top of mind with people. So I think the Fed wants to be, more certain than not that inflation's coming down, which forces them to be tighter for longer, hold rates at these restrictive levels, for longer than what the market is pricing in. And so I think that is a challenging setup for risk assets right now, because risk assets are pricing in this aggressive easing cycle that really the Fed, and even we heard from the ECB this morning, neither of those central banks can really deliver that pace of easing, because they are worried about a reacceleration of inflation later this year. And when you have such a drastic loosening of financial conditions like we've seen over the course of the last 2 to 3 months, it makes it very difficult. I mean, financial conditions, according to Bloomberg Financial Conditions Index, Goldman Financial Conditions Index, and the Chicago Fed Financial Conditions Index, are as loose as they've been really since the tightening cycle began. So there's this big dichotomy here where the Fed believes its policy is significantly restrictive, and yet financial conditions are as loose as they've ever been. So I think that's a concern, and something the Fed is going to start to maybe push back against. It does not want to see this reacceleration of inflation become top of mind again.
Yeah, they're in a very difficult spot. I'd like to take us over to U.S. debt, but it feels like the inflation theme is going to probably play through our discussion here a little bit. So about 50% of the 34 trillion in U.S. debt is set to mature over the next 3 years. So that's about 17 trillion, with about 7.6 trillion maturing in this year alone. And in the same time frame, the U.S. is going to probably add, based on the current run rate, 10 to 12 trillion in additional debt. It means the U.S. is going to need to finance about 27 trillion, and the rates are currently 5%. And you're in the camp of higher for longer. If the Fed keeps them up this high and they're able to do that for several years, just that 17 trillion alone puts the debt servicing at 1.35 trillion. We still have the other 17 trillion to finance, so debt servicing costs are over 2 trillion. Current tax receipts are 4.5 trillion-ish, if they stay steady or go up a little bit, we're talking 45% of all tax receipts is going to go to servicing the debt. And of course, if we actually do hit the wall and we do have a recession, tax receipts typically decline. So it would get worse in that scenario. Does the massive debt and debt servicing threaten the future of the economy? What will the Fed do? And how do you see this playing out?
Yeah, I mean, we're clearly on an unsustainable path. Various members of the Fed, including Powell himself, have said that continuously. I mean, if you look at the CBO estimate for the deficit, it goes up into the right as far as the eye can see, and for as long as the eye can see. So it's clear that this can't exist forever. But we have dysfunction in DC, right? We have basically continue to have split government, where we can't cut spending and we can't raise taxes. So the only thing that we could do is borrow more money. And so, up until up until the last couple of years, that demand for extra debt has been either bought by foreigners or has been bought by the Fed with various QE programs. It's certainly been bought by the private sector here. Pensions have been kind of regulated into owning more. Banks have been regulated into owning more. So, I suspect that will continue. But I think the big issue that we have going forward now is we are going to increasingly be losing foreign demand for U.S. Treasuries. I mean, we have, been quite irresponsible with the budget deficits, with inflation, but we've also been, I would say fairly irresponsible with the way that we've decided to treat, Russian reserves and Russia foreign reserves, right? And so you're creating this environment where various other owners of U.S. Treasuries may ultimately find themselves to be considered enemies of the U.S. and have those reserves sanctioned or expropriated or frozen. And so increasingly, you're going to see the likes of China or Saudi Arabia or UAE or whoever decide, I don't really think I want to be holding as many excess reserves in U.S. Treasuries going forward. So, that will continue to weigh on foreign demand, and that will force the private sector in the U.S., whether it's the banks, primary dealers, and more likely what will end up happening eventually, the Fed will have to come back in and monetize the debt. So I think we are on a path to that, but that pendulum undulates back and forth. The Fed tries to create tight policy, strong dollar, maybe to force in folks to buy the treasuries, but that the dollar strengthens too much, it slows down the rest of the world. Overseas sellers of treasuries then come in, like we saw in the third quarter. China was selling, Japan was selling, and then the yields in the U.S. move up way too much. And then the Fed and Treasury says, oh no, this is a problem and we need to pivot again. So I think we're going to continue on that back and forth path, but the trend is not good. So ultimately, I think what winds up happening is the Fed will have to cut rates, weaken the dollar, and inflate away these debts. They don't want to do it right now, but I think over time, that's ultimately really the only solution unless we got a more unified government that could really take a bite out of spending. You'd probably have to take a big bite out of defense spending, and we probably have to raise taxes. It just doesn't seem like there's political will at this point
Not at all.
to do either of those things. So really, the outlet is going to be the dollar. The dollar is going to devalue against hard assets, against gold, against oil, against commodities, and we're going to have a much higher rate of inflation in the future. I think that's the end game we're looking at.
Well, you've taken this exactly where I was going. You've answered multiple questions that I had coming up. But when you say the end game, where we're going, do you see a resurgent fairly soon of inflation, sort of like what was experienced in the 70s and 40s, where there was multiple waves that came through?
Yeah, I think we're, as long as we're running these types of budget deficits, then yeah, I think that's what we're going to have. And so, does that resurgence of inflation happen immediately? I don't think so. I think the Fed, is putting some restraint in the economy to try to prevent that from happening. But I suspect that as we're exiting 2024 and moving into 2025, yeah, we're going to be talking about higher rates of inflation again. And I don't know specifically if we're going to be going back up to the 7-8%, rates that, we saw last, in 2020, end of 2021 and 22, but certainly something that looks, more than 2% is probably in the, mid-single digit camp is a reasonable expectation. And so I think that's really the only solution for the U.S. debt problems, and it's going to create, strain in the U.S. economy and strain in the populace and strain in society. And, so far we haven't had, really an Arab Spring like what happened in the Middle East, and I guess that was 2011, 2012. But it's and hopefully we don't. But I'm concerned that we might, right, as folks here start to, push back against that dollar debasement and this inflationary mindset.
With the elections coming up, it's quite possible that could be the spark to torch what you're talking about. So Reuters just shared an article the other day. You may have seen it. They stated that official U.S. Treasury flows data show that overseas private sector investors, namely banks, asset managers, insurance funds, pension funds, and retail investors, they're loading up on treasuries while the overall foreign holdings are flatlining. So basically, they're suggesting that the foreign central banks are not buying near as much as they did in the past, net sellers, like you said. But it seems as if for now, it's kind of like one group has been replaced by another group. Can you speak into this? Is this something that you think will last? Will these groups continue to be available to buy the treasuries?
Yeah, from a foreign perspective, I think what we've had is the yield differentials in the U.S. have still been okay, right? The U.S., yields in the U.S. are 5% plus, and in Japan they're, sub 1%, and so even FX hedge adjusted, it still favors owning some treasuries, and many more of these, foreigners maybe aren't hedging those holdings, and so they're picking up the yield, and they're benefiting from the high rates here. But I think over time, it's going to be hard to count on foreigners owning U.S. treasuries if we continue to run these types of deficits and this type of inflation. So I think more likely what's going to happen is domestic banks in the U.S. and domestic pension funds in the U.S. are going to be, incentivized or regulated into having to own more of the debt. I think that is a path that we could see coming in the future.
So can you speak into what you expect to see in terms of interest rates, purchasing power of the U.S. dollar if less foreigners are purchasing our debt and the government's imposing that on the banks and the pension funds?
Yeah, I mean, well, one thing we do need to mention is that there are, foreigners have U.S. dollar denominated debts as well, and so they need to find dollars in order to pay back those debts. Thankfully for the foreigners, the U.S. runs a massively negative net international investment position. So foreigners have, 7+ trillion, or maybe 7 trillion of treasuries, 13+ trillion of US dollar assets that they own, that they can sell in order to, service those debts. And we saw that in a large way in the third quarter, which was part of the selling of equities and the selling of US debt as oil prices were moving higher, and terms of trade for Japan and for Europe were deteriorating rapidly. They went and had to sell US dollar assets in order to, have enough money to pay for their elevated energy bills. So I think over time, though, as we get more of that foreign selling, it will force the Fed and the Treasury to, it'll force the Fed to lower rates here, which is the vehicle that will lead to that weakening dollar. And so that's going to destroy the purchasing power. It's going to negatively impact. I'm not going to say destroy. It'll negatively impact the purchasing power of the dollar, particularly against real assets, right? And the one obviously that I think is most concerning is energy. And so I think we're going to see, structurally higher energy costs across the board, end of this year and into the next, several years, as the amount of capital that's being invested into new exploration and new production, the growth rates of that continue to decline. We know there's shortages of capital that are going into these spaces. The U.S. rig count continues to fall, even though U.S. production has been elevated. The rig count is falling, and investment in the U.S. domestic energy industry continues to decelerate its growth rate. That's going to lead to higher energy costs and higher energy prices for U.S. consumers and for global consumers, later on this year, and certainly for the next several years, and similarly for other commodities. I mean, the amount of new investment that we're seeing in copper and in aluminum and lithium and the like, the growth rates of those are not commensurate with what is needed in order to keep pace with demand growth expectations. So I suspect we are going to be seeing supply-driven price increases across a wide swath of commodities, the second half of this decade. And that would accelerate as the U.S. dollar continues to devalue against those commodities.
Well, you've taken the conversation exactly where I'm planning on going, but I want to just ask you one more question on the central banks before we move to some of the commodities. There's multiple central banks are expected to ease, but like you had said, they're probably, they're on the fence. They don't want to ease, but there's been a lot of speculation that they're going to ease in 24 and 25, maybe even stimulate their economies if it comes to it, all in an effort to boost market confidence. China and Japan are already doing this. In fact, China just announced a $2 trillion yuan package, which is equal to about $300 US. What's your outlook regarding the current economic stimulus that's taking place by some of the banks, Japan, China, and any potential future stimulus? And in what segments of the economy would you expect this stimulus and easing to impact the most?
Yeah. Look, I mean, China is clearly the biggest marginal buyer of commodities and all commodities. And so, understanding what their stimulus packages look like and where their focus is of paramount importance. And China's been experiencing, a property deflation episode, right? Clearly, potential bust in their property markets, and their domestic banks are all on the hook for property loans, and so there is a chance that China, I think folks believe that China is gonna blow up, and that's going to lead to a deflationary bust throughout the world. I think what China has done, which is obviously very intelligent, has been to shift their buying of commodities away from dollar and into RMB, and so they now have the ability to print RMB in order to buy commodities. Right. And they can settle their, these excess trade terms with whether it's Russia or Saudi or whoever, either, in goods. Right. So China is exporting more goods to Saudi and to UAE and to Russia and to other OPEC producers. And they're paying, for oil in printed RMB. So they have done a good job, I think, versus some of the worst fears about China blowing up would have been come to fruition if they couldn't have made that transition. If they were forced to look for dollars in order to buy commodities, they'd be in a much worse place. So I think that's been a very intelligent and structural shift that I don't think many in the markets were expecting and have been really understanding. But China, the question for China is how much stimulus are they going to do and where are they going to focus it? Are they just going to continue to build infrastructure and property again, or are they going to shift the pace of stimulus to more consumption and giving money to the people? And I think the jury is still out. I think they've been tolerant of a slowing and decelerating economy so far, and despite continuous calling from investors and the West to have China stimulate, do like what they did at the end of 2008 and 2009, early 2009, they've been reluctant to do it because they know how much overcapacity there is in China and how much overbuilding has already taken place. So I think they've been methodical. They're going slower than folks would have expected. And I think they're going to be thinking more about stimulus towards consumption rather than simply, doing what they've done, for the last 30 years and putting it into infrastructure and into property. So I think maybe that's more constructive on the margin for energy commodities and for agriculture commodities than maybe it is for base and bulk metals. But, China's it's not like they're going to do no stimulus into property and infrastructure. There'll always be a little bit of that. So, but that's another flag for future inflation, right? If China has been not buying as many commodities over the last few years as expected, as they start to come back into the market, it's going to tighten up supply-demand balance sheets across a variety of commodity curves again. So this is something that I think the Fed and the ECB and all global central banks are going to have to think about, as we exit 24 and move into 25. How low can they bring interest rates in a world of inflation that no longer looks like the era that we saw from, let's say, 2000 to 2020, right? We're no longer in this 2% inflation world. And I think so far, we really haven't seen many, at least in the monetary policy world, have embraced this this shift up in inflation, right? We've seen, many think this is just been a transitory episode. But I think the concept of deglobalization continues. I think that, as we move into a geopolitical world that is more strained, where supply chains need to be duplicated and elongated, where there's shipping concerns about, in a variety of trade lanes, demographics moving in the wrong direction, right? There are structural forces now on the inflation side which are changing. And so I think central banks haven't really moved their expectations of forward inflation and the neutral rate up yet. And I think that transition, will start to happen. It takes time, but that is a concern going forward. And I think it's something that central banks are going to be dealing with. And so expectations for, let's say rates in the U.S. moving back, back down from the zero bound. I don't suspect that we're going to be in that kind of environment again.
All great points, and all makes you wonder how then the debt servicing is going to play with the budget. And I've heard Luke Roman talk about fiscal dominance multiple times, and that's what it sounds like we're in. Yeah,
it's bizarre how dysfunctional DC has become. You basically, the Republicans eliminated their speaker, brought in another speaker who was supposed to be, somebody who was going to be even harder to move on spending assumption on spending growth. And it looks like in this upcoming budget, there's just going to be more spending. I mean, there's even talked about another tax credit, in the court that may cost this year $125 billion, right? It's a 10-year tax credit. That's going to be, over time, won't impact the deficit. But in the first 2 years, it's a $200 billion drag on tax receipts. So there just doesn't seem to be any real desire to, and so far, look, the bond market hasn't really forced the issue, right? We haven't seen the bond vigilantes come back and, force the Congress into action. I mean, there was some evidence maybe of that in the third quarter as term premiums moved significantly positive when Yellen announced at the end of July a big increase in duration issuance, and that led to a fairly sizable bond market sell-off in the third quarter of last year. And then what happened at the next quarterly refunding announcement? She chickened out and said, actually, we're not going to issue as much duration for the next quarter. And so the bond market took that as a sign that both DC and the Fed were kind of watching this and didn't want this to happen. And so there was a pivot, and bonds rallied and the dollar weakened again. So we'll see, but it doesn't appear like bond vigilantes have enough power to really force any change in DC. And so for now, we just kind of have this continual back and forth where deficits keep rising and inflation doesn't really get back to target. And people who really suffer the most are unfortunately are U.S. citizens who are working two jobs, can't make ends meet, trying to just keep pace and struggling. And like I said earlier, so far we haven't really seen it show up in a deterioration in the society. But I mean, like you said, we do have an election coming up, and I'm not rooting for chaos, but perhaps that's something that may result.
Yeah, 2024 is going to be a most interesting year for sure. I'd like to move us over to gold. This is a topic you touched on a little earlier, but global central banks have continued to accelerate a 9-year trend of buying gold and selling treasuries to the point where it seems very clear that there is a shift from treasuries to gold as the primary reserve asset for central banks. According to Luke Groman, since 2018, gold has quietly outperformed long-term U.S. treasuries in total return by approximately 75%. Can you speak into this, and what's your gold outlook for the next 1, 3, 5 years?
Yeah, look, I mean, I think, Luke's on to, has made some great points here, and I, subscribe to that thesis. And, what you have is, a multipolar world of trade is reestablishing itself away from exclusively trading in US dollars to trading across a wide degree of currencies. And whether it's Russia trading with India in rupees or China trading with UAE in RMB, when those trade balances get out of whack and one country owns too much of the other country's currency because the offset on goods trade doesn't keep up, there are outlets where those excess reserves can just be stored in gold. And we're seeing, a larger degree of that type of flow transpire. And so I think after, the BRICS conference in August of 2022 of last year, and the admission of new countries, into the BRICS universe, Saudi, UAE, Iran, right? You have more of the world's energy producers looking to trade away from dollars and will store excess reserves in gold that could be settled and traded in Dubai or in Shanghai or wherever. And so I think that trend will continue. And these countries that used to store excess reserves in U.S. treasuries will continue to gradually move that storage into that excess reserve storage, into gold. So I think that ship has sailed. You really can see that in the dichotomy of the divergence between the historical correlation of real rates in the U.S. and gold, right? I mean, as real rates rise in the U.S., typically that's been a pretty big headwind for gold. This cycle, we really haven't seen that, right? We've seen a pretty big breakdown. As real rates in the U.S. have risen, gold has held in incredibly well. And gold in various other currencies is also at all-time highs. So I think that trend continues. I would expect, gold to continue to move higher. Another 15 to 20% up this year, and again the next year, and again the year after. And I think there is a view potentially that I know that Luke has, where to the extent that we really needed to revalue gold materially higher in order to help the U.S. Pay down debt and offset these debt positions, that could happen, a kind of one time. I think that's a very low probability event, but something that we gotta think about as markets and risk gets unruly, and longer term solutions are looked at. But it does seem like gold needs to be a larger part of everyone's portfolio on a going forward basis.
Well, what a great segue. In 2023, there was a CNBC interview with Ray Dalio, the founder and chairman of Bridgewater, and he was asked how much a fund or an individual should have in their portfolio of gold, and his answer was a 10 to 15% overlay on the portfolio. Do you agree with Ray, and why?
Yeah, I think that's a very reasonable allocation, and I think today probably the average allocation is less than 1%, right? So I mean, just the move from 1 to 2 and 2 to 5 and beyond. I mean, these could be massive inflows, into gold, and would lead to significantly higher gold prices. But gold really is, the ownership of gold is a call option on the dysfunction of the current monetary system that is being driven by that had been driven by the U.S. dollar, and is being driven by this idea that the U.S. government deficits, which had funded the world for since Bretton Woods in the mid 40s, have just gotten too high, and the rest of the world is kind of saying, you know what, we're not having it anymore. And so because the rest of the world has suffered at the hand of the U.S. And the U.S. dollar in a lot of ways. It's hamstrung many countries' abilities to grow. It's hamstrung their middle class's abilities to move out of poverty. And so countries with resources and countries with manufacturing capacity, with trade goods, no longer want to be subjected to the U.S. government's printing regime. And so I think gold is a call option on that trend, continuing and kind of eventually moving away. And so, I think I'd say a 10 to 15% allocation. I mean, that's a reasonable estimate, but certainly,
and more of a long term hold rather than a move in, move out kind of a thing.
Yeah, look, I mean, it's not even just the U.S. debts, right? I mean, Europe has debts. China has debts. The whole world governments have debts well beyond their ability to.
I think the number's closing in on 350 trillion is what I heard.
That's a staggering number. So the only real way out of that debt cycle is going to be through inflation. And so ownership of hard assets protects you from wealth expropriation by your government deflating the currency. And so some combination of gold with property, with disposable commodities like oil, and equities that have pricing power, that type of portfolio, I think really makes sense. And I think what you'll see is a shift away from, risk parity and stock bond portfolios, where to a portfolio that kind of upweights the gold component, upweights the commodity component, and downshifts the government bond component, because you're just being paid back, in deflated currencies, deflated dollars, and eventually, governments and central banks will cap those yields. Like we were talking about earlier. I mean, the U.S. government can't really survive forever at a 5% plus interest rate regime. It's eventually going to have to take those yields and cap them, and whether it's some sort of yield curve control or buying of treasuries, and so by owning those bonds, you're not really going to be paid a rate that keeps up with inflation. So I think shifting some of that fixed income exposure to commodities and gold makes a ton of sense.
I appreciate all that. And it sounds very bearish for the future for treasuries, from what I'm hearing.
Yeah, I mean, I think 30. I mean, I think being short the U.S. 30-year bond makes a ton of sense. I think eventually we're going to see a very significant steepening of the yield curve. I would imagine long end yields in the U.S. Move materially higher through the course of this year and into next year, and so yeah, this is not a place that I would want to hold, really anything. But I mean, look, on a short term bond basis, you still are able to invest in 5% T bills, and so that's
Right.
a reasonable place to kind of park cash. But locking in 30-year bonds or at less than 4.5% just doesn't seem like it makes any sense to me.
Especially when you know that the purchasing power by the time you get paid is going to be so much less. All right, well, let's shift over to silver. It's currently priced at just 50% about of its nominal highs and substantially below its inflation adjusted highs. It's used in more applications today, solar, military electrification. The gold to silver ratio is currently roughly about 90 and the historical mean's about 50. The majority of the mined silver comes as a byproduct of mining for other metals, and global silver mining supply was down this past year. What upside do you see for silver, if any?
Yeah, look, I think silver, really needs a more robust global growth environment in order to work. I don't see silver as much as it's been largely demonetized, right? I think over time, it doesn't kind of hold that similar like gold does. As a store of value, I think it doesn't really have the same type of cachet, maybe like it did 30, 50 years ago, as a monetary vehicle. But I do think it has value, obviously, into all these new applications. And so it's much more, for me, going to be a product of global growth reacceleration. And so we haven't really had that dynamic in play. Certainly, China's been slowing. Japan's been slow. Europe has been slow. And so I think in order for silver to start to work, you need to get this global growth reacceleration again. And so I think this is more of as we transition through this year, and China stimulus does come back, and the global economy kind of goes through its soft patch, and then central banks react and lower the cost of capital again. As we exit 24 into 25, and maybe the global growth environment looks a bit better, I think that's a very robust environment for silver, for copper. But I think it's a different trade than gold, where I see gold as really more of this kind of dollar debasement, fiat debasement type construct and storing of excess reserves idea, much more so than I do silver.
Okay. All right, let's shift over to oil. I have a few questions here for you on oil. It's been recently reported by the Wall Street Journal that 20% of all global oil sales in 2023 did not settle with the US dollar. That's a high number, and the trend is increasing, not decreasing. The petrodollar grip seems to be weakening substantially. More and more nations that are buying oil from each other are choosing to settle the trades with their currencies, goods, gold. You talked about that earlier. Can you speak into the impact that this is going to have on a more widespread basis? And do you expect the U.S. government to take any actions, including potentially war, to prevent this trend from turning into an avalanche?
I mean, I think this trend, the horse is out of the barn here, right? I mean, we're going to have a continued trend of bilateral trade away from U.S. dollars. There is just no need certainly for Russia and for Iran, who really don't trade in dollars. They're selling more oil away from dollars, and now you're going to have the likes of Saudi and of UAE and other OPEC plus producers selling oil in local currency, whether their own local currency, if they're selling to China in RMB, sell to India in rupees, or settle in dirhams or in reals, whatever it is, and store excess savings and reserves in gold. So I think that trend continues. There's just no reason for countries to have to feel like they need to use the dollar to settle commodity trade really anymore. And so China and BRICS at large have created this this other system that is allowing for oil trade away from USD. And I think that that will continue. And so, given how important dollar settlement of oil has been over the course of the last 40 years in funding the U.S. government and funding the buying of treasuries, as we continue to lose that demand, that has adverse implications for the U.S. Bond market. So I think that continues. And as far as the other thing that it does is it allows these other countries like China to basically print their own currency in order to buy energy. And so to the extent that China is able to buy energy in RMB while Europe is buying energy in US dollars, there is a competitive disadvantage to Europe, right? And so, I mean, we're seeing Germany for sure has been feeling the negative brunt of that energy issue for them. They've been forced to pay higher costs for oil, for natural gas, because of the sanctions on Russia. And so their ability to compete globally and export has been drastically impacted negatively because of this. And I think that will continue, where a country's ability to procure cheap energy is going to be a very big strategic advantage. Frankly, that's been an advantage for the U.S. and will continue to be an advantage for the U.S. given our natural gas situation here and cheap gas in the U.S. But for countries like Japan and for Europe, there are headwinds for their abilities to compete globally unless they're able to procure cheap oil and cheap gas. And as long as there are sanctions against Russia, it's going to be difficult for them.
Yeah. So regarding the cheap oil and gas here in the States, it's been reported that shale oil has accounted for all of the oil growth that the U.S. has had over the last decade and accounts for 75% of all of the U.S. oil production in total. And the Permian Basin is the main driver. The most crucial development in global oil markets currently seems to be that there's a depletion going on in the Permian Basin. Some analysts believe that the basin could peak by the end of the year. So this couldn't come at a worse time for the oil markets. Inventories are tight, production is declining around the world, and investors are extremely complacent, like you've mentioned multiple times today. The industry's been starved of capital for decades regarding the carbon neutral narrative that's pushed fossil fuels off to the side. People just haven't wanted to really invest. Oil is still heavily used, though, to the point that all of the $5+ trillion investment that's been made in the new technologies over the last 20 years really hasn't lessened our dependency on oil at all. It's very negligible. So with that said, could you expand your oil outlook over the next 1 to 5 years in terms of price, tightness, and any other challenges that you could see?
Yeah, I mean, it's a great point. I mean, the Biden administration's energy policies have been not particularly favorable to domestic U.S. Oil and natural gas producers. I mean, the drilling has continued, and U.S. oil and natural gas production growth is, I believe, very close to, if not back to the highs. But a lot of that has been natural gas liquids, and what we're seeing now is this fall in the rig count, and the investment and the growth rate of CapEx as you look ahead to 24 and to 25 just doesn't look commensurate with a resurgence of production growth kind of beyond what we've had this year. And so we are potentially falling into a situation where we're going to be, the U.S. is going to have to, the only cure for this is going to be higher prices, right? I mean, and so I think, you could argue that the Biden administration was prudent in the way that they sold reserves in the SPR to try to make sure that global energy prices did not run away and destroy the economy and destroy the U.S. consumer, but it was a penny wise, pound foolish decision in that it really, like, once again, kind of changed the psyche of the CEO in the Bakken or in the Permian about how they think about production growth and how they think about CapEx. And, given there's still, uncertainty about how this election will go, I don't suspect you're going to hear a lot of oil company CEOs talking about CapEx budget increases with all this uncertainty around the upcoming election. They're just gonna sit on cash and buy back stock and pay out dividends and kind of wait this out. And the longer they wait to put back capital into the ground, the worse it becomes for some of those short life basins. And so the depletion rates can accelerate, and we could really find ourselves in a situation where U.S. shale just is not able to make up the supply growth that is needed in order to balance the market. We also have, Saudi and Russia have taken barrels off the market because demand has been more sluggish than they would have otherwise thought. And so we are, as the U.S. loses barrel growth, we're ceding market share globally back to OPEC plus. And so, in order to restore that, we're going to see higher prices. And I think, again, as we kind of transition through this global growth soft patch here in the first half of 24, and we start to exit 2024, as demand starts to come back, it's going to come back at a higher cost of energy. It wouldn't surprise me to see oil prices, back above $90 as we end the year, and kind of grinding higher as we move into 2025, because there is just no easy, supply growth button that could be pushed. And I think Saudi and Russia will just be pragmatic and prudent with the way that they bring back on barrels. Like, there's no real desire for them to kind of, flood the market too soon. As the market needs more oil, they'll just bring it back, which will make it more difficult for the U.S. to think about that production growth. So as opposed to an oil spike, I just think we'll see kind of, continuously a grind higher in oil, and particularly as we exit 24, maybe into a better growth environment, which will reignite those inflation expectations and those inflation worries, around the election and into next year.
So currently, energy as a percentage of S&P is about 3.4%. It's historically averaged 8.07%. So it's sitting almost 60% below the 3.5 decade mean going back to 1990. It peaked a couple of times, 1990, 2007 at 13.5%. And around the pandemic time, it bottomed out at 2.28. So we're closer still to that bottom. We're substantially below the mean. Do you see a reversion to the mean with these higher prices, more investments going to eventually flow in? Or do you see the political headwinds still preventing the necessary investment and creating a more prolonged higher price environment?
Yeah, I unfortunately do think that, the results of the election will matter. But the sector is typically driven by price momentum, and as price momentum starts to improve, it'll drive forward earnings momentum, and then these stocks will trade better on positive earnings revisions. So I think the first half of this year is more of a challenge still, because we'd like to see global growth really start to reaccelerate. And again, as we mentioned earlier, I see a slowdown first before I see that that resurgence of growth. So I think typically, when growth is decelerating, it's harder for these cyclical industries and for commodity producers to attract capital and for these industries to outperform. But again, as we move through this year, that shift makes a lot more sense. And so, I see myself tilting towards more of a kind of pro-inflationary portfolio, maybe a little bit, maybe the third quarter this year, and certainly for 2025. But, I think it's a little early to be too overweight in these more cyclical areas of the economy. I mean, even just look at, some of the earnings that have come through, even this week, whether it's from, the likes of DuPont or 3M or, some of the more cyclical areas of the economy. The numbers have just not been have just not been very good, and the stocks have been hit for it. So I'm a little bit more cautious on the earnings outlooks near term, and maybe as we transition into the back half of this year, I think that's a more prudent time to really start to step in.
Okay. Well, before we wrap up here, Craig, and I ask you the final question, I just want to remind everyone that if you're a premium subscriber to our Substack, which is MetalsandMiners.substack.com, not only do you get a bunch of free content throughout the week, but you also get a few extra things. The nugget notes from each interview, that's our downloadable recap summary of the discussion with Craig. Some premium interview content with Craig that is not on this video, and access to the Metals and Miners critical report library, among other benefits. If you've enjoyed this conversation with Craig, even half as much as I have, and would like him to come back on and tackle other big issues of our time or update us in the future, please let him know by hitting the like button, clicking on the red subscribe button, and the little bell icon. Okay, Craig, in wrapping up our discussion, I have two final questions. It's really a two-part. When you're on a client call, what are your clients worried about today? What direction and advice are you giving them? And what specifically have we not touched on in this conversation that you want people to strongly consider for 2024?
Yeah, I think what folks are concerned, or what folks see, is a change in the inflationary environment versus the prior 20 years, right? And so I think they also see a potential transition at the central bank, where, look, in the past, the Fed had always responded aggressively to declines in growth with an easing cycle. And the reason they were able to do that is because there was no inflation. And so this idea that the Fed would come in, ease policy, and you could just buy the dip every single time, I think was a very prudent strategy, made people a lot of money from, throughout the last couple of decades. And what people see now is a return to a more inflationary environment that's going to be more challenging to arrest, right? And particularly around demographics and the labor market, wages moving higher, maybe union power getting stronger, and corporate profits having to maybe bear the brunt of some of this labor momentum, and the Fed's ability to react as aggressively to growth concerns maybe is likely to be more muted than it has been in the past when there was no inflation. And so clients and folks that I chat with are thinking about and trying to understand how to transition their portfolios, which have benefited from deflationary tailwinds for the better part of 2 decades, into portfolios that will benefit from more inflationary tailwinds going forward. And since not many people were around trading in the 70s or when there was a much higher rate of inflation, they're looking for historical understanding of what assets work and what things don't work in those environments. But the other thing that people are concerned about is certainly this level of debt in the U.S. And I am definitely hearing this a fair bit more when I talk. It's just, what is the solution? What is the end game for the U.S. government's debt situation? We're running, $1 trillion, $1.5 trillion, $2 trillion deficits per year. What would happen if we went into a recession and we needed to, move that up by another trillion or so? Who's going to buy the debt? That is becoming more of a concern. And for older folks or retirees who have the ballast of their portfolios tied into fixed income, what are they, how do they react? What are they going to do? And so I think those are the concerns, or those are the things that are on clients' minds. As far as one thing we didn't touch on, and maybe it has become a little bit more top of mind, is with this ETF approvals of Bitcoin, whether or not crypto should be, or Bitcoin should be part of a portfolio. So I think that is something that people are starting to think about more, talk about more, trying to understand more. Can Bitcoin be, some sort of solution on a going forward basis? So I happen to be a Bitcoin bull for the long term. I think it is an interesting store of value proposition. Uh, Certainly for folks who are faced in with hyperinflationary regimes, or are being forced to flee their homes because of war and have to leave with their wealth. You can leave with all your wealth, in a 12-word coded message. That was something that you were unable to do at any point in time in the past. So I think there is a long-term use case here for a small allocation to Bitcoin specifically, nothing else in crypto. But folks are trying to understand this a little bit more, and whether or not this is going to be part of, or should be part of their portfolios on a going forward basis.
Well, I would love to discuss that with you more the next time you're on. I really appreciate it. Thank you so much for your generosity of your time, your analysis, your ideas, for coming on to Metals and Miners. It's been so good to spend this time with you. And you're welcome to come back at any time that you want, share updates with us about what's going on in the economy and markets. Would you please share with the viewers where they can learn more about your work, how they can connect with you, and where you can be found on social media?
Absolutely. Thanks. So for the most part, look, I trade my own money, but what I do is I also offer macro advisory and consulting services for LaDucTrading. So if you go to LaDucTrading.com, you could find me there, and we run a live trading room. We have a dedicated Slack channel where I provide real-time market commentary throughout the trading day about what I'm seeing and what I'm doing and what I'm trading. So definitely be happy to engage with folks over there. So thanks again.
Wonderful. Yeah, wonderful. Craig, thanks again. I really enjoyed it.
All right, Gary. Take care. Thank you.